Good morning and welcome to this overview of the Anglo American Platinum 2016 annual results, which we announced to the market today. By way of a brief overview up front, we had a disappointing fatality performance in 2016, a solid operating performance from our own and joint venture operations, with good cost control and a great unit cost outcome for the year. We delivered a substantial reduction in net debt, and all operations were cash positive. Whilst notable progress was also made on the strategic repositioning of the portfolio during the year. I'll now touch on each of these aspects in a little more detail. Our disappointing safety performance was marked by the tragic loss of 7 of our employees. I would like to pay respects to Mr. Kubeka, Mr. Ntamelo, Mr. Henrico, Mr. Nkambia, Mr. Mataboche, Mr. Sabonti, and Mr. Leshuelu, who were fatally injured at our operations in 2016. Our sincere condolences go to their family, friends, and colleagues. The increase in work-related fatalities is particularly distressing, given that there was a steady improvement in the underlying safety performance in many of the lagging safety indicators that we measure. For example, we had a record fatality-free period across the company of 323 days fatal-free. That ended on the 31st of March. There was a 26% reduction in the lost time injury frequency rate, and we saw a 31% improvement in the total recordable case frequency rates. Clearly, in 2017, our priority remains on further improving the operational safety performance, with particular focus on ensuring full adherence to critical controls by all employees. On the health side, we've seen a significant reduction in employee HIV and TB-related deaths as the company continues to encourage the uptake and participation of our disease management programs. Our environmental management systems have once again ensured that we've had no major environmental incidents in the period. Moving on to production from the operations. The full year's produced platinum ounces from all sources was 2.38 million ounces, up 2% year on year. Retained own mines production was up 5% year on year to 956,000 ounces. Mogalakwena mine continued its strong performance in 2016 with a record 412,000 ounces of produced platinum for the year. That was up 5% on 2015's 392,000 ounces. The on-mine production improvement was primarily due to higher mill throughput, up 8% year on year, and improved plant recoveries up 1%. Amandelbult's turnaround continues with 467,000 ounces of platinum produced in 2016. That was up 7% year on year. Unki mine had a sterling performance in 2016, producing 75,000 ounces. That was 12% up year on year and above the nameplate capacity. For the non-core operations, Union Mine produced 151,000 ounces of platinum, up 7% year on year, and a good turnaround following the restructuring. The Rustenburg mines were under our management for 10 months until the 1st of November and produced 460,000 ounces of platinum in 2016. That was down 4% year on year, impacted by the fatalities and difficult mining conditions. Operational improvements were evident in the last period as the mine was unaffected by safety issues. Our joint venture and associate operations had a strong production performance at all the operations, up 2% year on year to 785,000 ounces. In terms of the total refined platinum production, that decreased by 5% year on year to 2.335 million ounces, mainly as a result of the run-out of the furnace at Waterfall Smelter in September. This impacted refined production by 65,000 ounces, and has led to an increase in the work in process inventory. This is expected to be refined in full during 2017. The decrease in refined inventory was also a result of lower stock gain in 2016 than that of 2015's by some 70,000 ounces of platinum. This lower pipeline inventory led to less material in process to physically refine. Platinum sales in 2016 amounted to 2.416 million ounces, 2% down year on year, and were higher than the 2016 refined production as sales were supplemented by a drawdown in refined inventory. This strong operating performance is further reflected in the tight control of unit costs across the business, up only 1.4% year on year. That's versus a CPI of 6.3%, contributing to a total of 3.5 billion rand of operating free cash flow being generated in 2016. All operations were cash positive for the year. Our 2016 financial results reflected a stronger EBITDA of 9.1 billion, up 5% year on year, due to the operational improvements I mentioned earlier, overhead reductions, and together with a higher rand basket price. 2016 headline earnings are solid at 1.9 billion rand or 7.13 rand per share. If one removes the impact of the special items, such as impairments and restructuring costs, then underlying earnings improved from 3.64 rand to 7.84 rand per share. Headline earnings were impacted by changes in the South African tax rules on controlled foreign companies, which contributed to an increase in the effective tax rate to 34%, reducing 2016 headline earnings by an incremental 1.10 rand per share. Capex was down by 9% to 3.4 billion rand. That was slightly below our guidance as a result of lower project capital as we continue to focus on disciplined capital allocation across the operations. We strengthened the balance sheet during the year with a net debt reduction of 5.5 billion rand to 7.3 billion, benefiting from improved operating cash flows, working capital reduction, and upfront proceeds from the sale of Rustenburg, positioning us well for the future. In 2016, we also made notable progress on the strategic repositioning of the portfolio. The sale of Rustenburg is complete, and Sibanye took over operational control and ownership on the 1st of November, as I mentioned. We've signed an SPA to sell long-dated mineral resources within the Mandelbult mining right to Northam for 1 billion rand, and we signed a sale and purchase agreement to dispose of our non-core asset, the Pandora joint venture, to Lonmin. Today we've achieved another milestone in our repositioning, as we announced that we've signed an SPA to dispose of the Union Mine and Masa Chrome assets to Sianda. Additional detail on this transaction is available in the separate release that we provided to the market today. We are continuing to focus on right-sizing the company's overhead for a smaller, less complex business. The early benefits of the restructuring are showing, and we've reduced the overhead by 35%, and this will further reduce with the sale of Union Mine. So looking to the year ahead, we are guiding to platinum production of between 2.35 and 2.4 million ounces, driven by an increase in production from third parties. Our own mine production will stay constant at around 960,000 ounces. Unit cash cost guidance will be between 20,350 and 20,850 rand per ounce, including the impact of capitalizing less waste at Mogalakwena. Capitalized waste stripping will reduce to circa 800 million rand in 2017. With disciplined capital allocation, without negatively impacting the future of the business. Our capital expenditure guidance for 2017 is between 3.7 billion and 4.2 billion rand. This includes the rebuild of the number 2 furnace at Waterfall Smelter as part of our ongoing maintenance program. Net debt will reduce further in 2017 at current spot and FX rates, and through the disposal proceeds from the sale of mineral resources to Northam of 1 billion rand, the sale of the Union Mine to Sianda, which will provide 400 million rand of upfront proceeds, as well as a second customer prepayment of $100 million. We are making progress on our repositioning and will continue to progress the transactions in execution and anticipate the majority will be complete in 2017. In closing, the challenging global macroeconomic environment is likely to continue in 2017. However, our results show that we're delivering change, building a resilient business, and we will continue to position the company for the future. Lastly, I would like to take this opportunity to thank my executive team, managers, and all employees for their contributions to the business in 2016. Your efforts are greatly appreciated as we set this business up for the future. Thank you for listening in, and goodbye.